If you know my story, one rental at a time, you know that I started with the 1% rule in real estate. What that simply is, hey, if it's $100,000 purchase, it has to rent for $1,000. Very quickly, I realized that that rule of thumb leads to very, very bad decisions, pushes you towards lower quality properties in war zones because, hey, that's where you can find the 1% rule. Well, you know what? There's a 4% rule pushed by Wall Street and mutual funds that I hate equally bad. And I'm going to push on Taylor because I think his industry pushes this, makes us think we're doing okay. But I freaking hate it. So Taylor,
Yeah.
how you doing?
So I don't hate it as much as you, and I will support some of the facts along the way, but I'm going to let you throw all the fastballs high and tight at my chin, and then I'll try to protect us Wall Street folks, if you will, as best as I can. So let's do this.
Yeah. So again, the 4% rule. This is how I consume and believe in the 4% rule. It's basically, hey, mom and dad, put some money away every paycheck for 40 years. And then, oh, by the way, when you're done and retired, you can live on, you can withdraw 4% from this magic pile of money and live out your golden years. That's what I believe the 4% rule is pitched. We'll start there.
Yes, you're correct. So essentially the 4% rule says that you can withdraw 4% and be comfortable that living throughout your entire life, regardless of market conditions, if you take all of the prior market conditions and play it out, you will have enough money to live out your life, drawing that 4% income down without ever running out of money.
Okay, that's a wonderful theory. Might call it a rule of thumb. It certainly helps Wall Street because it teaches us just to put money away every paycheck. I get it. But there are some realities, right? One of them being if you happen to have bad timing and exit during a bear market where you see the market rip 20% lower and you start removing the 4%, that can have a lasting and compounding negative effect. I mean, that is, I think, one of the mathematical, true statements that's not really talked about is timing. Like, it's far better retire in a bull market than a bear market.
No doubt. But the 4% rule does take into account bad markets. So withdrawing 4%, even through a bad market, historically has been that magic number that says over time, again, good markets, bad markets, they will correct themselves. And if you're only withdrawing 4%, you still have the bulk of your money that's sitting there, even if you're withdrawing on the onset during a bear market. And it does account for that with something like 99% certainty, giving any single environment we've ever seen throughout history, and there have been some nasty ones, obviously, that 4% will allow you to have enough money to take that out in perpetuity and not run out of money.
The other thing that kind of annoys me is for a lot of folks, it means they have to live on less, right? Let's say you have a $2 million portfolio at the end of 40 years.
Yep.
4% of 2 million is 80 grand. If I'm doing my math correctly.
Yep.
That's,
so that is a very viable. So I won't counter that with anything because that's just the fact, right? If you have $2 million and you're taking out 4%, that's 80 grand a year, and you have to deal with that with, however you're going to deal with that. And again, not to mention, I'll compound your problem there a little bit, is a lot of times this is assets that sit within a 401k. And so if they're sitting within a 401k, you've not paid taxes on them yet. And if you take out 4%, all of a sudden you're taking out 80 grand, but then that's hit with whatever tax bracket you're in at that given time. And that comes down to 65 grand or whatever it is to your respective tax bracket. But there's no doubt about that. So that has to be taken with some serious merit to say, listen, how much cash flow am I going to actually need coming into retirement? And if it's more than 80 grand a year, unfortunately, you're going to have to save more than $2 million or invest to get that total over $2 million to have that ultimate comfort of relying on the 4% rule that has been, at least historically, such a good rule of thumb.
Yeah. And then the last thing about the 4% rule, again, it's very much, I believe, Wall Street, probably mutual funds created, pushed, marketed. It kind of treats like other investments as non-options. It's like, hey, just trust me. The market will take care of you. You don't need to look at other assets. Just give me your money and I'll take care of you. That rubs me the wrong way also.
Oh, I totally agree with you. And one of the things that I've told you that I've done is as I own commercial real estate.
Yeah.
And, you know, going back, I admittedly wish it was residential, not commercial. And maybe the commercial is a little less work. And I might not be saying that if I held residential and had some of the work associated with that. But nonetheless, my income is dependent upon the stock market and the bond market, you know, the markets in general. And because of that, I looked at myself in the mirror and said, listen, if my income is based upon this, my future investments are based upon this. What happens if things go sideways and downward? I need something to diversify this income stream at a different, you know, at a different way. And so I said to myself, where could that be? Well, commercial real estate, residential real estate, whatever it is. And it's not to say there isn't correlation there, because I think that's a fool's argument to say that there's no correlation between real estate and the market. We talked in the last episode about wealth effect and how that can, you know, perpetuate real estate prices higher or lower. But nonetheless, it certainly isn't a one-to-one correlation, and the cash flow that it can generate is definitely differentiated in that of investments. And so part of my retirement nest egg that I've already set up is this significant chunk of commercial real estate that I purchased 5 years ago or something like that.
Yeah. I just think so let me just kind of come back. I think like we said earlier, the 4% rule is an interesting idea. I think it is helpful. I think a lot of people should, I mean, something I did my entire career is I always got the company match. So I'm not against 401ks. In fact, I had a 401k since my first 40-hour-a-week job. I think there's other things. I don't like kind of getting to the end and going backwards, for sure. I think there's other ways, whether it be commercial or residential. There's just other things that people should do to balance their portfolio, because the 4% rule, it's not enough for most people. You can do other things.
Yeah. If we're looking at this and saying, hey, you know, should I be maxing my 401k or whatever it is? My thought on that is from a rule of thumb standpoint, and again, maybe this comes from an inherent bias of where I've come from, is you should always do your best to maximize, in my opinion, your 401k. And here's why. So think about this, especially for higher income earners. That's important to understand too. Higher income earners are going to be sitting in at the highest tax bracket, 37% tax bracket. So that is 37% of your money that you have that becomes investable for you right now, that if you do it in any other fashion, will have paid taxes and you'll have 37% less. So that 37%, especially if you have a long time frame to compound, can become a magnificent amount of money over time that in any other investment vehicle would not compound. You would have already given that to Uncle Sam. And then the kicker on that is on the back end, when you do retire and start to withdraw these assets, likely you're at a lower tax bracket. Now, that is to say that's likely. That's not to say that that's definite, because we don't know with our national debt situation that we have, how in the direction of tax brackets, where they're going to have to go over time in order to get our massive deficit back down to more reasonable nature. We don't know what that means for tax brackets. So that is the big unknown, is will you in fact be in a significantly lower tax bracket when you withdraw that money down the line? But nonetheless, the thing that you can guarantee right now is that 37%, or again, if you're in 22% tax bracket, 22% is going to be invested and working for you now, and it wouldn't be in any other format.
Yeah, I like that. And again, I've always gotten the company match. I've always considered that free money.
And the company matches. Yeah. So that's literally just saying, hey, if you put in 3%, we'll put in 3%, and boom, you're off to the races. That's the easy decision, in my opinion.
Oh, absolutely. So again, folks, I'm not really against the 4% rule. I am certainly against the 1% rule in real estate. I think it leads to bad decisions. I do think the 4% rule, if you don't dig in and realize kind of what it might look like at the end, could set you up for a surprise. I do like that Taylor says, hey, personally, he added commercial real estate. Some of you might add residential. I think it's part of the overall pie. I want you to have a retirement that you are proud of, not one that you're sacrificing in. Taylor, where can people find you?
Not one that you're stuck with.
Yeah, exactly.
Yeah. So follow us at Life Goal Investments. I'm on both Instagram and on TikTok, putting out daily content, breaking down the markets, the economy in like simplistic layman's terms.
Awesome, buddy. Thank you so much.
Thank you.